Since most of these cash transactions we've been talking about, cash receipts or cash payments, are going to involve banks, and we can use banks then to help us with controls. We can use the bank so that we have restricted access. We can have the wire transfers going through the bank. It helps us because we have documentation procedures that will involve the deposit slips and the other banking records. And also we can use it as a way to independently verify that the amounts we say go to the bank went to the bank, or that the checks are going through the accounting system and the bank system in the same values. So one important thing that needs to be done then, we can use as a way to independently check our records, is to use the bank statement and compare that to the accounting records. And we can do it, as I said before, from a business or an individual. Either way, a business can do bank reconciliations, or individuals. As I said earlier, individuals really should be doing bank reconciliations, but I have my doubts about whether people really do them or not. Now, I personally do bank reconciliations, however, I don't do them as much as I should. Technically, we should be doing these bank reconciliations every time we receive a bank statement. And if you're a business, you should be doing a bank reconciliation at least monthly. A bank statement that comes to you will be coming to you from a different source. It is an external document. It's not a document that you generate. It's generated by the bank. And so it's comparing your records to the records of the bank. And you're only going to be able to address those things that relate to the bank statement in this. So in other words, the other sources of cash, or the other types of cash which you have, including petty cash, you can't address or you can't verify through this. We're not going to be able to do anything much with that. But what we can do with it is look at everything that flows through the bank and compare that to our accounting records that relate to this particular bank account. The bank statement is going to discuss all the things that go in and out, and we would call these debits and credits. And it's also going to talk about the balance. It's going to show you the balance at different points in time. The bank will have charges on it. The bank statement will have charges on it that we have not recorded. There will also be things in our records that don't show up within the bank statement. So therefore, we can go down here and we can look at this bottom number, which is $10,638.40. This is probably not going to be our ledger balance for cash, because we're going to have items that are going to be recorded on the bank and not recorded in our records, that'll be recorded in our records that won't be in the bank, and we'll have things that result from timing differences. And so our job is going to be to create a bank reconciliation which somehow relates this number of $10,638.40 to the balance that we're showing in our bank ledger account. So a bank reconciliation does not mean we have to find an agreement. It means we need to find the differences between the numbers. We need to explain why the bank shows a certain balance but why we show another balance. Is it because one of us made a mistake? So up here you notice that it says the bank can make an error. I've seen this happen in my account. I have had funds put in my account and that should have been put in another bank customer's account. That happens. The bank made an error. And unfortunately someone else is hurt by it because they aren't getting the funds in their account. Sometimes our accounting system makes errors. We talked about it. We're not error-free. You can do a debit and a credit for a certain amount, and your check may be cut for a different amount. This is an error because it's going to go through the bank records and it's going to show up in the bank statement for one amount, and it's going to be in your accounting records for a different amount. This is only one type of error that we could make. We may not know about interest that's being given to us on our account. Some accounts, if the balance is high, if we keep our balance sufficiently high, the bank will pay us interest. They generally pay us interest on our average balance. We don't know what the average balance outstanding is. We can't estimate that amount. We can't put in a journal entry, and we won't know till the end of the month when we get the bank statement that tells us how much it's going to be. We should be aware of electronic fund transfers or transfers between bank accounts. We should always be aware of that. If we're not aware of it, and so we haven't done the journal entry, we may be required to do a journal entry to make things balance. Service charges are the charges the bank charges us for any type of service on our account. This could be a check. This could be a fund because we have a customer that gave us a bad check. So the bank is going to charge an insufficient funds charge for having the bad check. It's not the amount of the bad check. It's a charge because the bank had to process this bad check. And it could also be a service charge that's related to us having wire transfers, having EFTs. It could be related to having checks ordered. It could be related to a amount that's charged every month for us to have that account at that bank. All kinds of service charges can happen on bank accounts. And then the customers can give us a bad check, which means that our deposit is not going to really be for that full amount of the deposit because one of the checks that we tried to deposit is not going to be honored by the bank, and therefore our deposit will be less. Now on the bank side, the primary thing you're going to see is deposits that we make recently that are not yet showing up in the bank's records, and checks that we write that have not gone through the banking system yet. So when we write a check, we're going to do a journal entry and it's going to hit our accounting system immediately. If we send the check in the mail, there's going to be a delay until the customer or whoever we're sending this check to receives the check, takes the check to the bank, and actually deposits it. So there's a lag. There's a lag between us writing the check and the check actually going through the banking system. There's a lag between us depositing it at the bank and the banking system may not process it because it's, say, after 2 o'clock in the afternoon. All these things are differences, and what we have to do is we have to reconcile the bank account balance, which was this $10,638.40, and our cash account balance. They need to be reconciled. We need to figure out where the differences are. The standard bank reconciliation form, which everyone should be very familiar with and feel good about using, starts with the bank account balance, the ending balance on the bank on one side, so the bank's on one side and the company is on the other side. This is our ledger balance. Our ledger balance from our ledger account. This is the balance that the bank had on the bank statement. You add back deposits in transit, which are deposits the bank is not yet honored. You subtract the outstanding checks with the checks that we are showing up in our accounting system and which are not yet processed by the banking system. This comes up with this balance. On our company's records, we notice there's interest that we have failed to record. We have an EFT or electronics funds transfer, a customer paying on their account we didn't record. We have a bad check which we failed to take out of our bank balance. We have bank service charges we are just now learning about, and we actually made an error in our accounting records for $9. When we do all of this work, notice what we are saying is I can determine why this number does not agree to this number. The reason this number does not agree to this number is that there are timing problems at the bank. And this is to be expected. Every month we will have these timing problems. But we also have some things over here that there are problems. We are going to need to do journal entries. And if we do our journal entries, we are going to adjust for all these things in the middle after we've done our journal entry, we'll get our cash balance that is for our bank account to the correct balance, which is $11,478.40. So, what we need to do is go to the right side of that bank reconciliation and pick up, I'll go back to show you again, pick up all these items here, and additions are going to be debits to the cash account, deductions are going to be credits to the cash account, and for all these debits and all these credits, we're going to need to have offsets. So if you can guess about these kind of, interest received from a bank is going to be debiting the bank account, and it's going to be credited what? Interest received. What would that be? Yes, revenue, interest revenue. An electronic funds transfer from a customer. If this customer is paying off their accounts receivable, it's going to be a credit to an accounts receivable. And then you're going to do the same thing down here. These are deductions, so they're going to be credits to our bank cash account, and that means we need to debit certain things. And so we're going to have to figure out what we're going to debit these. This is noted, they're noted 3A, 3B, 3C, 3D, and 3E, so that when we go to our next slide and we actually do the journal entries, it's going to line up with these letters over here. We had service charges for the bank. These are going to be recorded in D. They're calling it office expenses. We often see it recorded as miscellaneous expenses. Now, a customer's check was rejected as insufficient funds. Well, that means we will probably try to set it up as an account receivable, which is what we are doing here in C, and we are going to try to collect it from the customer. In B, as I said before, we are receiving funds directly transferred into our account, probably a payment of an accounts receivable. I discussed A as being interest revenue. I've discussed D. In E, it's a little crazy, because what you have to do is you have to pull that check. You're going to have a copy of all the checks, because a check is a document. You're going to have a copy of that check in your records, and you're going to have to try to figure out what the offset account is. In this case, it was a payment of an accounts payable, and so the error should be a debit to accounts payable. After we put all these journal entries into our accounting system, our cash account balance will then be updated, so it is that adjusted balance or that bottom line on the bank reconciliation. If it's done properly, our adjusted balance is equal to the bottom line on the bank reconciliation. Now, petty cash systems we also need to handle, because money is going to come into the fund. We're going to fund the account, and the money is going to come out of it. The petty cashier is going to take the money out, and then we need to replenish it. The important thing is we don't do journal entries for all of these things. We only do a journal entry to establish it over here, and we do a journal entry to replenish it. So in establishing the account, what we're going to do is we're going to create a separate asset, which is really a part of our total cash. It's going to be called petty cash. And petty cash is going to be funded by writing out a check in the name of the petty cashier, whoever that might be, and we're going to give this individual a check for $100 and say, go to the bank, cash the check, and put this money in the locked box. And then what's going to happen is the cashier, if they're doing their job right, every time they take money out of it, they are going to record the fact that the cash has gone out. And they're going to probably write it on a piece of paper, maybe a notepad, and they're going to keep these receipts. They're going to keep the receipts for the money going out. This case, they're going to pay yellow checker cab for taxi fare to the airport, and they paid $21. So their cash drawer is going to go down by $21. At the end of the time period, they're going to count up all the money that's gone out. They're also going to count out what they have. They're going to make sure they have receipts for everything. There's no journal entry done at that point. The journal entry happens at the end of the month when we go through and we determine what needs to be put back into the fund. So, this particular cashier paid money for supplies, for travel expenses, and for other office supplies, office expenses. So the cash that came out of this drawer was $67 during the time period. What we are going to do is not credit the petty cash, we're going to credit cash. Why are we crediting cash? Because we are going to cut another check, and this check is going to be for the $67 that replenishes the funds that the petty cashier has. The $67 in cash, or the check that's written for $67, the cashier is going to take to the bank. She's going to cash it, bring back the $67, put it back in the locked box, and with that she'll be back to having $100 in her cash box again. So the reason why we are crediting cash is because we are cutting a check. In general, when you see cash credited, it's because a check has been cut. The exception to this is the bank reconciliation, which we just did.